Good evening to everyone. We'll begin in 5 minutes. So it's 6:30, but we have just 8 students here, 9 students. I'll wait a couple of minutes and we'll begin in 2 minutes. Okay, let's get started. So before we move to our today's topic, I'd like to tell you that I saw 10 groups with 48 students registered for our group work. So I expect that you should start sending me drafts of your evaluation. We discussed everything that you need for discounted cash flow valuation, and today we'll be discussing relative valuation. After that, you'll have all theory necessary for your assignment. The next lecture will be about practice with free cash flow valuation. We'll take a company, a Russian company, and we'll build a free cash flow model to value this company, and relative valuation to the next lecture. But you can start now, and at least you can start with some industry forecast, market forecast, general ideas about what do you expect from Volkswagen. So please start now, because we still have about 4 weeks until then, but 4 weeks is not too much. You'll see that. So I'm waiting for your draft models, reports, your questions, and so on. And with that, we go to our current topic. So today, our topic is market-based or relative valuation. We discussed that in our first lecture, and in the first lecture, I told you that relative valuation has its pro and contra, and there are reasons why people sometimes prefer using relative valuation over free cash flow, although free cash flow valuation, of course, is the most theoretically grounded approach, because with free cash flow valuation, we try to forecast future income from this security or from this company. And this is exactly why we buy companies, why we buy shares. But this direct and theoretically strong approach isn't that convenient in many cases, because it will take too much time to prepare our valuation report, to make a conclusion about the company. So in many cases, we go another way. We use market-based or relative valuation. The basic idea about relative valuation is that just like with an apartment or a house, we find similar companies and value our company or price our company based on prices for those similar companies. And just like with a house, we never compare house to house or apartment to apartment, but instead we use a coefficient, a multiple. In case of houses, it's for a price per square meter. Just like that, with companies, we use a multiple, use a coefficient to translate a price of one company into a price of another company. So relative valuation consists of three basic steps. First, we have to find this comparable or a benchmark. Second, we should calculate some standardized value that we call a multiple. And we'll use this standardized value to calculate expected price of our company. And I can tell you that although relative valuation is not that theoretically strong as free cash flow valuation, in fact, most valuation reports, specifically 85% of all valuation reports and more than 50% of all acquisition valuations are done based on relative valuation approach, because it's easier, because it's faster, and because of some other reasons. We'll discuss it later. And even that's very interesting. Even in most cases, when we use free cash flow or DCF approach to value a company, in those valuation models, in those valuation reports, we have terminal value. And with this terminal value, in many cases, like in venture capital valuation, for example, we use relative valuation to calculate this terminal value of a company. And in the next lecture, we'll discuss how much of a value of a number that we calculate as a value of a company actually depends on this terminal value. So even with free cash flow valuation, in many cases in our valuation report, this market-based valuation is hidden in our terminal value. In some other cases, when we calculate discount rates, or when we just build a fully fledged free cash flow valuation report, we in fact think about expected value that we get from this valuation report based on what we calculated quickly with our relative valuation approach. So even when we use DCF analysis, in some cases, relative valuation is hidden inside those valuation reports. So this is a very popular approach, and of course, the main reason why it's so popular is the last point here in this list. It's because it's easy. Because with relative valuation, we can calculate expected value of a company in 5 minutes. So that's why relative valuation is so popular. But there are other reasons why we prefer relative valuation over free cash flow valuation. And the first reason is that with relative valuation, we don't go too far from the market. With free cash flow, we have absolutely independent opinion. We don't ask the market. We don't believe in what the other people do or think about fair prices. We calculate our own expected value or estimated value. But the problem is, even if we are much smarter than the market, when we can get our profit from this fact, from the fact that we are so smarter. When we have 10 years or 20 years to hold these shares, like sometimes in private equity, we can still work with free cash flow valuation and don't hesitate about all the others. But if the share for 3 months or a year, or maybe 2 years, then the profit will make from this investment will be made not from free cash flow of this company, but from change in its price, in the price of its shares. And what if the market, after a year, still doesn't understand what we understood a year ago? If the market doesn't understand it, if the market doesn't believe in these future profits of the company, then the price will not adjust to the level we expect. And if the price won't adjust, it means that we cannot get profit from our investment, even if this company is in fact that good investment. So with market-based approach, we don't go too far from the market. We're looking for the company, or companies that are relatively undervalued or relatively overvalued, not absolutely. So our understanding is focused on a difference between one stock and another stock, and this is the type of difference that will be captured, we expect, by the market much quicker. So it will be a matter of months, maybe a year. And if we calculated, if we analyzed everything correctly, then probably the market will adjust the price to the level we expected a year ago. So with market-based valuation, we're looking for incorrectly priced companies, and we can expect that those errors in pricing will be corrected in a shorter period of time. So this is a first fundamental reason why we use relative valuation so fast, so often. And the second reason is that in many cases, the valuation we do is done for portfolio managers, for example. And portfolio managers, of course, they would be happy to capture any existing value that available on the market, but it's enough for them to overperform some general market index, or let's say just overperform the market. So if those managers can invest in relatively undervalued shares or sell relatively overvalued shares, it would be enough for them to overperform the market. So relative valuation in this case is just good enough for portfolio managers as a guidance for their investments. So that's why we use relative valuation so often. So once again, the general procedure for relative valuation is, first, we create a set of companies our company and some similar companies, some comparable companies, industry peers, for most cases. We will discuss other approaches, but for most cases, we're looking for several industry peers, maybe 5, 10 sounds maybe too long list. 5, I would say starting from 5, it looks okay, but in some cases you cannot find 5 or 6 or 7 companies, and you work with maybe 3, 4 companies. We will see that 3 or 4 companies can create for you problems because of difference values for their multiples, but sometimes you just don't have a better choice. So for this initial set of companies, you should collect all necessary data, and this necessary data is market value, reported financial results, if you can, expected financial results for the next year, maybe years ahead, and for some cases, operating results. Because you'll see that we can create our multiples, we can calculate multiples based not just on historical performance of the company, but also on forecasted or expected performance of the company. And we can use sometimes even not financial, but operating results to analyze its value. So this is the first step. We just collect the data. And collecting this data, you usually prepare a table in a spreadsheet and collect all this data in this table. At least you'll need market capitalization, debt, together they give you enterprise value, and things like net profit, EBITDA, maybe equity from the balance sheet, reported equity, and sales. This is a standard set of data you need for a company, and of course, looking for the benchmarks for comparables. You should choose only companies for which this information is available. But for public companies, and we now discuss within this part of the course, we discussing public companies. For public companies, all this information is always available. Second part is to choose the indicators that will be our drivers for value. Just like with a house, we understand that square meters is a driver for the price of the house. And for companies, what could be a driver? What defines the value of a company? It can be profit. Sometimes it can be EBITDA. Sometimes it can be just sales. Sometimes it's balance value, and so on. So the second step is to choose the driver that we believe actually defines the value of this company. Third step is to calculate this driver, this multiple, for all comparable companies, and then calculate in some way the average multiple for this set of benchmarks. And the last step, using this driver, this multiple, we calculate expected value of our company and make a decision. Is this company overvalued, undervalued, and so on. And you can expect that if we choose several drivers, then several drivers can give us several different conclusions. And sometimes we'll see that by one indicator, by one multiple, the company is undervalued, and by another multiple, it's overvalued. In this case, we have a choice. We can either calculate some average value of a company based on several calculations, based on several multiples, or we can just analyze the conclusions made on several multiples and choose one multiple that we believe is the strongest predictor of the company value. So throughout today's course, we'll be discussing relative valuation, and for this relative valuation, I've chosen Magnit as our example. Magnit is the leading Russian food retail chain with current market capitalization of 510 billion rubles. I calculate everything in rubles here, although for Magnit, and that's an interesting case. For Magnit, there are shares and GDRs, global depository receipts, and so for shares and for GDRs, Magnit has two different prices, and not just because each GDR contain I don't remember 10 or 20 shares, but also because actually valuation for the company on two stock exchanges, those two valuations are different. But we'll be using for today, we'll be using just pricing from Moscow Exchange. We'll be talking about shares, and I converted all information I had about all companies into rubles, just to make it simple. So Magnit has about 22,000 stores by the end of last year. Today it's more, but we'll discuss this change in the end of this lecture. Today there were news about Magnit. And those 22,000 stores are mostly just convenience stores, and Magnit Convenience is 77% of its sales. By the way, I just now I see that total here is more than 100%. I don't know where is the error. I believe that maybe they mixed family supermarket and extra superstores, or maybe they added Magnit Cosmetic in some of those groups. But that was percentage from their corporate presentation. But anyway, Magnit convenience stores, they actually about 3/3 of their business. They have relatively new division, Magnit Cosmetic, and they have some supermarkets, but they are not the main part of their business. They have some pharmacy division. They have plans in e-commerce, but didn't do a lot for that. And they have my price discounters. This is another part of the business, but they are just imagine they don't play a serious role in their business. So basically, Magnit is a convenience store chain. So what companies can be comparable for Magnit? We have two convenient comparables. It's X5 Retail Group. X5 Retail Group is how would say they like exactly the same business as Magnit. So they about the same size. They have maybe X5 has more supermarkets in their chain. I'm not sure, but they still have a very large proportion of convenience stores. And another good comparable is Lenta. Lenta is again a food retail or FMCG retail chain, and they're a bit small, not a bit, about 3 times smaller or 4 times smaller than Magnit. But this is not a very big difference. I mean, we still can use Lenta as a company of the same scale as Magnit, and we can calculate multiples based on information from Lenta. So X5 and Lenta are good comparables for Magnit. There are other retail chains in Russia, but they all have some problems for us. For example, OK. OK is another food retail chain, but the problem with OK is that it's much smaller, maybe 20 times, 30 times, 40 times smaller. I don't know the number, but I believe it's about 30 times smaller than Magnit. So I excluded them from my comparison, although you could add them as another comparable. You could add non-food retail chains like Детский Мир or Fixed Price, but they have another problem. This is not a food retail, so that's retail, but this is a different kind of retail, and we can expect that this business has different drivers. So our drivers, value of our multiples, I'm not sure that they're applicable to Magnit. We could also use some foreign companies from Eastern Europe, for example, to add them to our list. And in real relative valuation, of course, we had to do something of this. Add one of these 3 companies, or add some Eastern European companies, because it's not enough to have just 2 comparables. But for this lesson for today, I will be using just X5 and Lenta just to make it shorter, all my calculations. But for real valuation, you'll need something like 5 or more companies. So with this idea that we have to find comparables and calculate this indicator, this value driver, we have to choose our value drivers first. And basically all value drivers that we use are divided into 2 fundamental groups. This is price multiples and enterprise value multiples. With price multiples, we calculate market capitalization of a company. And if we add, roughly speaking, company consists of two types of capital. It's equity and debt. So if we know market capitalization, which is equity of a company, market price of equity, market value of equity, we can add market value of debt for this company, and we get enterprise value. So we can use our multiples based on price of a share or based on enterprise value. And of course, when we talk about price, and later in this lecture, when I talk about price, we should understand that they are interchangeable. We can use the term price of one share or equity as total price of all shares. So this is our choice. And with those comparables, or with those multiples, we can calculate their value based on two different approaches. And in the beginning, I told you that relative valuation sometimes is hidden inside free cash flow valuation. But the opposite is also true sometimes. Free cash flow valuation is sometimes hidden inside relative valuation, because there are two ways to calculate those multiples. First is exactly what I explained, exactly by calculating those multiples from comparable companies. But we also can calculate our multiples without comparable companies. We can calculate them based on fundamental characteristics of our company. And in fact, this is not a relative valuation approach. This is free cash flow valuation translated into relative valuation terms. We'll see that on price to equity multiple. So there are two ways of calculating multiples. We can use either comparables, and with comparables, the idea is that two similar assets should be, generally speaking, priced similarly. They should have the same drivers, the same price for the same size, and so we can expect that we can calculate value or fair value of our company based on prices for other companies. With fundamentals, this is not relative valuation. This is just using relative valuation terms to present free cash flow valuation. But if we use the first approach to calculate our multiples, then what we need here is comparables, comparable companies. I'll see this slide about forecasted fundamentals. I'll return to them when we have price to equity. And one second. Okay, I have my slides about types of comparables later, so I'll return to them. Now, our multiples. The most popular multiple that we use is price to earnings. And here, price is the value of equity, and earnings is net profit of the company. But we use terms not equity to net profit, but price to earnings, because here we focused on a share, on one share, and from one share we have price and EPS, earnings per share, instead of equity and net profit. Why we use this approach, this indicator so much? Because first, everybody knows that. Everybody knows this multiple. It's widely used, and we can easily communicate our opinion with this indicator. Second, this indicator is directly linked to two parameters that are usually discussed when we discuss any investments. First, it's changes in stock price. So this indicator uses stock returns based on changes in price. And the second is profit, net profit of a company. And because net profit, yes, we can say that we receive not net profit from our investments, but free cash flow of a company. That's true, but net profit is still a very good estimator for what we get from our investments in a company. So we use it a lot when we discuss quality of any business. So that's why we use price to earnings so much, because this is just a straightforward way to analyze the strengths, the return generating strengths of a company. But sometimes we will have issues with this indicator. First, what if the company in question doesn't have positive profit? If this company has losses right now, we discussed that with free cash flow valuation, and we told that this is not a big problem for us, because we need profit, we need dividends from our investments, but not now. Somewhere in the future, sometimes in very distant future. But with relative valuation, we cannot walk this way. We cannot afford what we could afford with free cash flow, because with free cash flow, we had, for example, 10 years forecasted for this company. But with relative valuation, we use just current results. And what if now this company has negative profit? That creates a big problem for us with price to earnings, because we just cannot apply this math, these calculations for this company. Second problem is that profit is actually quite unstable. Sometimes companies maybe they realize large projects, or they go through some changes, or there's a crisis, and because of this crisis, profits fell, and so on. Those short-term changes short-term difference between short-term profit that we see now in the company's reports and long-term expected profit. This difference is a big problem for us with price to earnings, because we react to current earnings, to current price, and sometimes that can be misleading because we capture these short-term events. And the last problem is that profit is the bottom line of financial report, and everything that the company's management did in their accounting, everything influences net profit. So the management of the company has a lot of discretion for how they present their profit. And this discretion can be because this changes can be because of decision of management. They can be because of differences in the law, in accounting principles in different countries. If we couldn't find comparables in our country, or if we use comparables for global companies, so those differences could create big problem for us. But nonetheless, price to earnings is the most popular multiple, the most popular indicator we use to calculate the value of the company. And basically, although those terms, trailing PE and forward PE, are actually, in fact, as you will see, quite vague. And if you check some, for example, some electronic systems like Bloomberg or Refinitiv Icon, you will probably not see the terms trailing and forward PE because they're too vague. They use LTM and NTM terms, but let's first discuss the idea of trailing and forward PE. The price, the P in PE indicator is the current price. This is simple part. The current price is the price today for any share that for which we calculate this multiple. But what is earnings here? Earnings is the net profit. What net profit for a company we have? We have actually many net profits. One simple explanation that the net profit is the last reported net profit, right? But even before we start discussing what is the last, let's first ask ourselves, are we interested in the past of the company? Or maybe we're looking for information about the future. We don't invest in the past. We invest in the future of this company. So it would be good to make at least one step ahead, one step forward, and analyze how the price of this company related to expected net profit for the next year. Because even the market, why the market priced this company this way or that way? Why the number is this? Because of expectations. of all analysts, of all investors on this market. And if that's true, and if we have expected net profit for the next year of a company, it would be good to use this number, not the last year's results. Of course, we have a problem here with the last year's results, with what we call trailing PE. Yes, Maxim, in both cases, the price is the price. It's current, it's today's price. Yes. So with forward PE, we would use expected net profit, but reported net profit is something very concrete. I have reported net profit of Magnit the same as your net profit or some others net profit. We all have the same reported net profit for the last year. But for expected net profit, it's not that clear. What is expected net profit of Magnit for 2025? Maybe I have my opinion, you have yours. So we all have different net profits. And my calculation of PE would not be the same as yours. So that adds some forecasting error to my calculations. But anyway, some companies, by the way, some companies publish consensus forecast for their parameters. I'll show you that. And you can use this consensus forecast for your calculations. So if we have relatively reliable expected income, expected net profit for the next year, then in most cases, you will use forward PE. So we use the next year's earnings because we invest in the future, not in the past. But if you don't have them, or if you feel that there are a lot of different opinions about expected net profit, so you feel uncomfortable with the numbers from this forecast, then you can use trailing price to equity, trailing PE. And as I said, in some cases, you will see, instead of, especially in electronic systems, where they have to be more concrete in their numbers, they use terms like LTM and NTM, which means last 12 months and next 12 months, instead of this trailing and forward. And that's why let's jump to this, and then I return to adjustments. That's why imagine that we have some company, and today we are in November 2020. So this is not the end of a year. This is not the end of a quarter. This is November 2020. What is our forward PE for this company? What do you think? The first is our we have 3 quarters with actual reported earnings per share. Then we have expected EPS for the 4th quarter and expected EPS for all 4 quarters of 2021. But what forward PE should be for this example? Which interval you use? Okay, I'll show you some possible explanations. First, next, what's the answer? No, we don't discuss growth rate now. Okay, we'll discuss the interval. So, first possible explanation. We are now in the beginning of fourth quarter. So the next year, because this company, as most companies in the world, reports by quarters, so we'll take 4 next quarters. This is first possible calculation of forward PE. Another possible example. Today is November, so our forward PE should start in December 2020 and go until the end of November 2021. So next 12 months NTM. Another possible explanation. We don't have financial report, actual financial report for 2020. So our 2020 result is actually a forecast. This is not a reported annual result. So our forward PE can be based on this 2020 result. And the last possible explanation is that the next year, we are now in 2020, the next year is 2021. So we should take the numbers for 2021 and calculate PE for those numbers. So 4 different explanations of the terms forward PE. And with these 4 possible explanations, by the way, we'll get very different results. If we use next 4 quarters, then we collect information for these 4 quarters, sum up all earnings per shares, we get 1.76 as earnings per share. Our price for today was $20. So our forward PE based on this idea is 11.4. If we calculate forward PE as next 12 months, then we'll have a problem here, of course, because we cannot find in companies' reports, we cannot find a separate report for December or for October and November of 2021. So we will calculate them just based on idea that all income is evenly distributed within those quarters. Actually, here in my calculation, I simplified that even more. I calculate that based on annual income. We had information in quarters, so we could do it more precisely, but I did it this way. So with this calculation, 1 month from 2020, 11 months from 2021, we get earnings per share 1.93, and our forward PE would be 10.4. If we believe that forward PE is calculated based on the nearest year where we have annual results forecasted, not reported, then 2020 is our nearest year, and for 2020 we have earnings per share 1.1, and that means that EPS is $20 over 1.1, and we get 18.2. And the last explanation, if the next year the full annual result, forecasted result, not reported, is our forward PE, then EPS for the next fiscal year is $2, and forward PE would be 20 over 2, it's 10. So we got 4 different results. What do you think? What result, what PE calculation looks the most, maybe not reliable, but the most relevant for our valuation? Any idea? Okay, no reaction. I think that the last one, as I said, because it's is based on forward PE, and at the same time, we use a full annual financial report. We don't play with this 1/12 of 2020, 11/12 of 2021 calculations. So the last one, it looks like the most relative approach to valuation. And although in my example with Magnit, I will not be using forecasted values just because I simplified it as much as I could. I use trailing PE for all calculations, but for Magnit, I think I paste exhibit from professional valuation report for Magnit, and you will see that they use next. No, it's not the next. They use the next year's forecasted results as the basis for their calculation. So the first thing with PE is how we find the best period, the best interval to calculate earnings. And we have now 2 answers, or maybe 3 answers. We have hierarchy. So the first step, if we have reliable next 12 months calculation, we use it. And that's exactly what electronic systems like Icon do. But the reliability of their next 12 months calculation is questionable. The second level in hierarchy, if we don't have next 12 months forecast, then probably we can create next fiscal year forecast. And that would be our best choice if we can calculate this forecast. And the last, if we don't have this next 12 months calculation, then we will be using last fiscal year reported net profit. as our basis, taking into account that this last year's profit can be not applicable for the future, because this is the past, and maybe we know something about this company. Maybe something's changed. Something's changed with Magnit today in the morning, by the way, and we'll discuss that in the end of lecture. But even without events like that, there always something that changes from year to year, and we just don't capture these changes if we use last year financial reports. What can be the difference? What can be the problem with any report that we use in our calculation? Now I return to this slide. If we use reported income from any company, then you should take into account some specific things that can distort your information about earnings of this company and how those earnings influence its value. And first, this is maybe not for public companies, but this is very relevant for private companies. Potential dilution of earnings. If the company has like convertible bonds or things like that, then dilution from these convertibles can distort information about price and net profit, and relationship between price and net profit. Second, maybe this company had something non-recurring in this year. Maybe, just example, maybe they had a significant revaluation of their assets, or things like that. Or maybe they drew down some assets. Something happened to this company, but this is a one-time event. Everybody knows that this event will not repeat in the future. So although this event can change net profit a lot, investors do not price this this component of net profit, because they understand that this component will not influence the future profits. So first big problem is that when you collected 5 or 10 comparables, and of course you will not spend too much time with each of those comparables, you can miss something important about events influenced their net profit. And sometimes those events can distort your multiples a lot. So you should be careful about non-recurring items in their financial reports. Another is cyclicality. If this is a cyclical company, so in good times this company loses a lot of profit. In bad times, sorry. In good times, this company has huge profit and so on. Then your calculation, your result will depend a lot on the year you've taken for your calculations. If it's a year from some crisis, you'll get one result, and if that's a good year, you'll get absolutely different result but your calculations, although you use 1 year result, those calculations, not for 1 year, not for 10 years, they for dozens of years. So all those cycles will repeat themselves many times. And because of that, sometimes instead of using directly taken from the report net profit, we use some recalculated net profit. I'll come to that later. And the last problem with comparables is differences in their accounting methods. I'll show you that with Magnit and the others. Okay, so these are adjustments we should do to our financial reports used to calculate multiples for our benchmarks. So first, that we discussed, time interval from which we take our financial report. For this time interval, we should think, was there something that influenced, distorted our calculations? And maybe we have some long-term differences in our companies that we use as comparables. So what's next? The next is if we understand that we have a cyclical company. This company, their results, their net profits change a lot from one economic cycle to another. In this case, we can calculate it not based on actual results, but based on normalized values. And you can see that for Magnit, for example, they publish information. This is this part. One second. This part is from their website. So they publish consensus forecast for their company. And you can see that they don't publish consensus forecast for earnings per share or for net income. Instead, they use net income margin or EBITDA margin for EV to EBITDA that we'll be discussing later. And they use sales goals year-to-year cost. So instead of using absolute numbers, they use those relative numbers, and you can use those relative numbers for your own calculation. That's because they try to normalize, to smooth their forecast and your forecast you use in this calculation. And this idea works roughly this way. If we have a company with earnings per share like this for the last 5 years, let's say, then instead of using 2020 earnings per share, which is here you can see that it's much lower than earnings per share for the other periods, but at the same time, book value of equity is different as well. I don't know why. This is quite random numbers. We can do now 2 things. First, we can calculate average, we call it normalized, earnings per share. This is just mean of 5 last earnings per shares. So with this earnings per share, we get, with this approach, we got 0.6 as our normalized average earnings per share. Now we calculate price to earnings based on current price, and we got in this case 39, about 39 PE. What's the problem with this approach? What do you think? Not weighted. No, this is even not the main problem. The problem here is that we directly collected this information about earnings per share for 5 years. So we believe average value doesn't reflect reality the best. Average value reflects average value. This is not the way we calculate average is not an issue in this case. An issue is another problem. We collected information for the last 5 years, and for 5 years it's a long time. For 5 years, many things could change for this company, but we still believe that their earnings per share 5 years from now have convey the same information, the same reliable information about their future profits as the last year's earnings per share. So we've created now a more stable formula. This formula does not depend on too much on a short-term crisis like 2020 crisis, but it's maybe too stable. It doesn't show us what happened to the company for the last 5 years, how the company changed. So this is the main problem. Another problem is, I will say that now we don't have a cure for this issue. We always have this choice to create a more stable calculation, more stable formula, or create a more sensitive formula that can capture what happened to the company recently. You will always have this choice, and you will always have to find a balance between this stability and sensitivity of your calculation. But there's another problem. What if the company maybe sold some assets, maybe bought something, so the mix of assets in the company changed, and because of this change in the mix, the earnings per share can change as well. In this case, we can go a bit different way. The difference actually not that big, but just for some cases when the equity of the company changed, that works better. Instead of calculating average earnings per share, we can calculate average return on equity. Return on equity is based on book value of equity, right? Not on the market value of equity. So we calculate, let's return to the last slide. We calculated return on equity for each year here, and then we calculated that average return on equity for this business is about 23%. So if in 2020, their book value of equity, it's now, by the way, I used in this calculation, I used incorrect, not 411, but 1 point. I've taken the first one instead of the last one. We had to take the last one to calculate earnings per share, and with that we could calculate price to equity. So the idea here is basically the same, but we just we prepared to account for changes in book value of equity. This is for cases like acquisitions or sale of assets of some equity, some part of business for this company. But generally, the idea is the same. So instead of using directly reported earnings, we calculate those earnings based on relative or normalized values. Those normalized values can be direct or with return on equity. Okay, so theoretically, this is what we do with price to earnings, to calculate price to earnings, and we could start applying these calculated numbers to our company. We'll discuss later how we calculate average values when we have many industry peers, and in each industry peer, in each comparable company generates, of course, different multiple. But before we go further, let's think about another way to calculate price to earnings without any comparable, without any actually relation to the market, but we use market, relative terms, we use multiples, but we don't use comparables, we don't use benchmarks, we don't use market to calculate their values. And here we have an idea of hiding free cash flow valuation inside the relative valuation. Look, let's recall what we discussed with DDM, with dividend discount model. With dividend discount model, we had the following. 1 second. Oh, no, the line. Value of a share is equal to expected dividend over discount rate minus growth rate, right? This is if we believe that this company will grow with a stable growth rate G, and this is golden growth model or just dividend discount model. But what if we divide both parts of this equation by expected earnings? Then we get that price, current price, because value here, this value is actually the same term as price, because this is value of a share, that is fair price for the share. So price over expected earnings is equal to expected dividend over expected earnings divided still by R minus G. And P over expected earnings is forward PE, right? So based on Gordon-Gross model, forward PE can be calculated as, and here D1, dividend over earnings, is actually a payout ratio, right? Or payout ratio, I don't know why, but payout ratio isn't that popular. Instead of that, in most formulas, they use reinvestment ratio. So 1 minus reinvestment rate is equal to payout rate. So so PE can be calculated as 1 minus B, which is reinvestment rate, divided by required return minus expected growth rate. Or with trailing PE, when the difference between forward and trailing is that in trailing PE we use earnings per share for the last period, or current earnings per share, or E0 here. And because that's Gordon-Gross rate, and in Gordon-Gross rate, we believe that the company, its earnings are growing with one and the same growth rate. So the difference between E1 and E0 is G, or it's multiplied by 1 plus G. And of course, for trailing PE, our expected price to earnings will be 1 minus B times 1 plus G over R minus G. Why do we need this? That helps us to link relative valuation and free cash flow valuation, and to use any term, any approach we prefer, regardless of what were our calculations for that. Was it something that's based on comparables, or we just have fundamentals, but we can use the same terms. With this approach, we can compare what we got from our relative valuation approach and from free cash flow approach. So this is just like a bridge between free cash flow and relative valuation. In real life, I would say, these justified multiples maybe not that that often met directly. I mean, you will not find in any valuation report that we calculated expected PE based on our fundamentals, but analysts often check what they got from one approach, from relative valuation approach, based on their expectations being calculated from fundamentals. So justified PE is an important tool to check what you got from your comparables, or to think about, or to analyze what you got as your multiples calculated based on comparables. So in practice, they often use, but not explicitly. They implicitly exist in conclusions, in decisions that analysts make. One second. Okay, The last thing we need is a benchmark, right? So we have a multiple, we understand how to work with this multiple, but we have to calculate it. This justified multiple is just something that we use as a check, but mostly we calculate our multiples using a benchmark, some comparable company or comparable asset, and those comparable assets can be actually different. The most natural comparable that we actually use in our example is our industry peers. So other companies from the same industry, companies that look a lot the same or maybe similar, companies that work based on the same business processes, on the same strategy, and so on. And you could say that there's no such company in the world. Every company has its own strategy, its own business processes, and so on. Yes, but still they look similar. They have a lot in common because they work in the same industry. They all try to be optimal, and there are not so many ways to be optimal in any niche in this industry. So we expect that we can find a lot of things, similar things in those companies. So if we have industry peers, we can calculate everything based on those peers. We have 3 other possible approaches. We can use industry or sector index, broad market index, and firms' own historical values for our calculations. But we'll return to that later. Now, about industry peers. For our company, as I said, they're quite natural industry peers for our calculations are X5 and Lenta. And I collected some information about those 2 companies. You can see that we had 510 billion rubles as market capitalization for Magnit. So X5 is about the same size, a bit bigger in terms of market capitalization. Lenta, it's actually not 3 times, it's 5 times less than Magnit, but still it's looks as a decent comparison to Magnit. And we could use other examples. Here is an example from evaluation report of Renaissance Capital and Magnit. And you can see that they use those X5 and Lenta, but they added OK. But I don't believe that OK is a good comparison because of its size. Look at the market capitalization. $7 billion for Magnit and $200 million for OK. And the company like that, maybe they have other drivers. But by the way, we discussed that in the first lecture. This is one of the sources of error when we use relative valuation approach, because in relative valuation we believe we base our calculation on the idea that there's one driver, just one driver that defines the value of the company, maybe earnings or EBITDA or whatever. But what if there are other drivers? In this case, what we're discussing now, earnings, but also size of the company. Does size of the company influence its value? I believe so. Do we use current? BSS. Konstantin, you asked about BSS, but what do you mean by BSS or BWS? Even with BWS, what does it mean? Book value per share. Not for this indicator. For our for normalized values. Yes, for normalized values we use book value per share, or just book value of equity if we have net profit as numerator, then just book value. Okay, but for book value we'll discuss later in another multiple this numbers. Okay, and I had another question. For normalized, you can use current, or you can use average for the last period, because it depends on your way of normalization. Okay, and about your question on the other countries, again, we'll discuss that later. Just wait a bit. Okay, so for this company, for OK, its size, it's another value driver, I'm quite sure. For retail chains, so their size definitely a driver, and in the terms that the size influences price to earnings. So not just the absolute number of value, but also relative number, the relative number for price for each dollar of earnings. So that's why I don't like OK here, and we exclude it from our calculations. But sometimes they can do that. And you can see another interesting thing here. Look at this table from Renaissance. What do you think about the PE? Is it we discussed forward trailing PE, next 12 months, last 12 months PE. What do you think about PE like here? 2021 PE, 2022 PE, 2023 PE. What do you think? How do we calculate PE for 2023? What is the formula? Okay, the price is still current price, right? And the earnings is our expected earnings in 2023, so nearly 3 years from now. And in this case, you can see that we discussed that forward PE is a better estimator for better predictor for value, because it's focused on the future of a company. And here you can see that in some cases, when analysts believe that they have reliable forecast for the next 2 or 3 years, that they believe that all other analysts have those reliable forecasts as well, and they can predict or forecast earnings in 2023, they can just calculate PE based on what the market expects from different companies in 2023. And in this case, this calculation is a mix of their forecasting, predicting ability, and just regular one period PE calculation. And again, just like with many decisions about multiples, indicators, approaches, and so on, you have a trade here between a better capture of the knowledge you have about the company, because here you base your opinion not on the current report, but on your expectations forecasted 3 years from now. And that's a better explanation of future of the company. But this is not reported profit. This is not what this company actually received. This is something that you expect the company will receive in the future, and not this year, but 3 years from now. And for those 3 years, many things can change. And your prediction of this profit can be far from reality. So you have more forecasting error and less, I don't know, economic, not economical error, but incorrectness of your approach. So less usage of use of the past of the company, more in the future, but with all possible errors, all possible mistakes you'll do on this way. So this is another way to calculate forward PE. So forward PE is not always for the next year. It can be even for the year, 2 years from now. Okay. And by the way, I think we should make a break, right? It's 8:10 now. Let's make it 10 minutes until 8:20. Okay. Okay, let's go on. And by the way, before we go back to the slides, I'd like to show you one thing. Just because when we talk about accounting differences and how accounting differences between companies can distort our price multiple or any multiple, it can look like something quite abstract. But look at one company, just one company, not two different companies. Magnit, the company we'll discuss. This is Magnit financial reports, and those financial reports are prepared in two versions by two different accounting standards. It's IAS 17 and IFRS 16. The difference between those two reports is in how this company presents its lease obligations. Actually, this is not traditional lease. This is their rent expense. So the money they pay to rent their buildings. But for companies like Magnit, for retail companies, IFRS requires IFRS 16 standard requires reporting this rent expense as just as financial lease. So within one company, we can see two versions of financial reports. And now let's look at the difference between those financial reports. So this one is the first version. This is the second version. Net profit. Net profit doesn't change too much, but still it's 38 billion rubles in one version and 33 billion rubles in another version. But so with price to earnings, the distortion from this accounting change wouldn't be very big. But EBITDA here it's 110 roughly 110 billion rubles, and here it's 180 billion rubles. So it's nearly twice that version. So the difference between EBITDA and these versions would be very big. And the same we will see with their balance sheet. Here, they didn't report their rent as a lease obligation. Here they reported it. And because of that, long-term borrowing is the same. They just they add lease obligation as a separate item here. But this is debt. And although in price to earnings, we don't use debt. In EV to EBITDA, in other enterprise value indicators, we do use debt because we add debt to market capitalization of a company. So these differences would definitely influence the company's valuation, the multiples we calculate. So the difference can be huge. And that's why you should be very careful with accounting principles used by different companies that you use as the basis for your valuation. Okay, now let's to our presentation. Okay. If we look at what we call justified price to earnings, and we believe that although we don't, even if we use comparables, we believe that those principles, those ideas still stay behind our calculations. And even if we use comparables, we believe that price to earnings can be calculated based on this formula. And in this formula, look at one letter, this G, growth rate. So growth rate influences the valuation, of not valuation, the multiple. So the multiple depends on growth rate of company. Required rate of return here is roughly speaking the same for all companies in our set of comparables. So there's no difference in R. But in G, in growth rate, the difference can exist. What if we use a company as a comparable company, as a benchmark, but we know that this company has different expected growth rate, not like our company? Then probably the valuation, the multiple should be different. Yes, and that's true. And actually, multiples calculated from industry peers can be distorted by different expected growth rates. And because of that, in addition to PE, there's another multiple, another indicator used in companies' valuation. It's called PEG or PEG, price to earnings and growth over growth. It's calculated the following way. It's forward PE over expected growth in percents. So we divide our PE by expected growth, and this way we account for different expected growth for different companies. Look at some very simple example. Suppose we have two companies. Company one has price 100, earnings per share 10, and growth rate 8. And company two has price 80, earnings per share 10, and growth rate 5%, expected growth rate. If we compare those companies based on their price to earnings, then we have to say that company two is undervalued. It looks quite straightforward. With the same earnings, this company has lower price, it's undervalued. But if we calculate now PEG ratio, then this 10 over 8 for company one gives us 1.25, and for the second company, 8 over 5% gives us 1.6. So PEG ratio is higher for company two. So the investors valued its earnings per share and growth higher than for company one. So the company two now looks overvalued. I actually didn't see PEC ratio in any real professional valuation reports. So this is more a theoretical tool, although of course you can apply it to any real company, to a real situation. But as a theoretical tool, as a way to understand drivers behind the company's value, this is a very important ratio. And by the way, in CFA exam, PEC ratio plays a big role. Unfortunately, just like all these simplified ratios, just like PE before we added growth, PEC ratio still loses a lot of information. It assumes that there is a linear relationship between expected growth and the company's value, but this relationship isn't necessarily linear. PEC ratio doesn't account for risk, and of course we expect that the higher is expected growth, the higher is risk that this growth won't happen. PEC ratio is one period, still just like all relative valuation approaches. This is one period multiple, while one period indicator. So in using this indicator, we don't have space where we can account for duration of this growth or dynamics of this growth. We just believe that one stock has one constant growth rate and another stock has another constant growth rate. So it doesn't help too much in real work with companies, but as a theoretical tool, this is a working approach. Okay, so we had so much problems to work with when we use industry peers, and with all those issues, with the fact that we don't have an effective tool to solve all these problems. We can probably say that you know, with such a rough tool, maybe we don't need to use specific industry peers. Let's just take a market index, which is actually a somehow weighted average of industry peers, of other companies. Let's take this market index and let's use this market index instead of specific companies. Sometimes it's even harder to do because just like with companies for market index, you need first, this is a simple part, but second, you need fundamentals like net profit or EBITDA or whatever. And net profit for a market index isn't always readily available like for a specific company. But for many indexes, you can find this information. So you can use just average market value taken from the index and use this market index. It can be industry or wide market index, broad market index, to calculate our multiples. But even if you use this simplified rough approach, there are still two things you can do. First, you should take into account that the market index is usually created by large companies, and larger companies have higher multiples, just like with the value and with everything. So you can account for that by one or another way. And another thing that you can use when you applying the multiples you calculated is the idea that you can use this multiple on historical basis. For example, I use broad market index, Moscow Exchange Index, to calculate price to earnings. But it doesn't mean, if I calculated this price to earnings multiple, it doesn't mean that I should apply this specific number to my company. What can I do? I can compare history for my company and price to earnings for the broad market index. If, for example, I know that for the last 10 years, on average, my company was traded 20% lower based on price to earnings as compared to the broad market index, to the Moscow Exchange Index, then I can calculate Moscow Exchange PE today, subtract 20% from that, and use this approach to calculate. Second. To calculate the value of my company now. So this is how we use these broad market indexes. And the last possible approach is actually there is one company that's very similar to the company we are analyzing. This is the same company, but in the past. We can use past values from the same company, and the idea here is the following. Okay, if for the last 5 years, my company was traded with average, like in this example, with average PE like 12, then probably I can apply the same PE for the current period. So if now this company is traded lower than its average level, then I can guess that maybe in the future the company will return to its long-term rate, long-term level. And if the company now is traded with PE 8, then the company looks undervalued. Of course, there are many things, just like when we took 5 years average EPS, there are many things that could happen in those 5 years. Any crisis, any change in the business, so many things. But still, this is just another way to look at the company. So we can use as comparables, we can use its own historical values. And that's all about our comparables and how we collect data to calculate multiple for the company. And the last question is, we excluded, I didn't use, for Magnita, I didn't use benchmarks from abroad, from from other countries. But sometimes this is the only choice for us. Or sometimes we believe that using other countries, using other companies from other countries will help us to see expected multiples just better. Okay, we can use it, but in this case, we should take into account two things. First is another country can use a different accounting standard. And you just saw that accounting standards can distort our calculations a lot. So you should be careful about what accounting standards are used in those other examples. And the second, of course, other countries are other economies with their own problems, benefits, and so on. And when we comparing, for example, Russia of 2021 with quite close Poland, for example, you should understand that access to financial markets in Russia has a lot of differences as compared to Poland now. And other countries sometimes have their own problems and so on. So those differences can be permanent or just sustainable and stable. So you should take into account the possibility of existence of such things. But if you see, for example, that you have two countries, for those two countries, they have their market indexes and their broad market indexes, and their broad market indexes have the same, let's say, PE, then probably the economy-wide differences not that big, and you can use companies from those countries in one set. So this is all about price to earnings. We've talked a lot about just one multiple, but with this one multiple, we actually discussed a lot of common things, things that common for all indicators, and just price to earnings is, I would say, the most important indicator for relative valuation. What other indicators can we use? What can be the value, the driver of value for a company? First, we've taken income, net profit. Second is assets. So the second indicator we can use is price to book value. Price to book value is calculated. Book value here is the book value of equity. So price is still our current price, and book value is our book value from the balance sheet, the book value of equity. Usually it's just ordinary share, not without preferred share. So book value of equity, it's usually lower than the market value of equity. Why? Because book value of equity consists of something that we bought as physical assets. And for example, the easiest example, people, our employees, they're not on our balance sheet, but they have some value for our business. And that's why our book value is always, not always, but in most cases, it's lower than our market value. And with this approach, we still have, again, have some problems with our calculation. And the first problem, maybe the most important thing for these multiples, is intangibles, all non-physical assets we have. Look, the company has assets. When we said that book value of a company is the book value of equity, it doesn't mean that we measure equity. We measured assets of the company, but we subtracted from these assets, we subtracted debt, we subtracted the part of assets financed by debt. But the idea behind this indicator is that we analyze the company's assets. And the company's assets consist of two big parts: tangible assets, something physical, like equipment, plant, land, buildings, and something intangible. And intangible assets sometimes are created by accounting techniques, accounting tools. So they are not that reliable. We're not always happy to work with those intangible assets. Because of that, in addition to a standard price to book value multiple, there is another possible approach when we use only tangible book values. This is price to tangible book value. And in this case, it's calculated as shareholders' equity, I mean book value, shareholders' equity minus intangible assets and minus goodwill. Because, you know, goodwill is the least maybe a reliable part of our assets. Goodwill is what we paid for another company in excess of its tangible assets, or its assets, not tangibles, all assets. So if we had a deal with a company, we bought a company, even if now after some time we understand that the current market value of this business we bought isn't that big, and we lost something in our goodwill, these assets can live long. So we exclude goodwill, we exclude sometimes intangible assets. If those intangible assets can be sold, so they have their own independent value, then we don't exclude them. But in most cases, we do it roughly, and we exclude everything, all intangible assets and goodwill. So this is another way to calculate price to book value. And just like with PE, we can derive from our DDM model, we can derive a fundamental formula for price to book value. If our value or price per share is equal to expected earnings times 1 minus reinvestment rate over R minus G, and we understand that expected earnings are equal to balance value of equity times ROE, because this is this from definition of ROI, and from the definition of this is not by definition, but from the idea of sustainable growth rate, we can say that if sustainable growth rate is equal to B times ROI, then B is equal to G over ROI. And putting those formulas to our main formula, we get the formula that price to balance is equal to ROI minus growth rate over rate of return minus growth rate. But I don't think that you need this formula unless you go into seek for CFA exam. For the formula of price to earnings, it is better to know it, just to have another way to check your calculations from comparables. But for price to balance, I don't think I don't use the formula. This is just as a theory. And now we can go further. Okay, if we use as a driver earnings or reported equity, we can go to the next possible driver, sales. Are sales a driver for the value? Of course, this is size of the company. Size of a company definitely can define its value. Yes, we understand that this is not a sale, not revenue that investor invest in. Investor pays not for revenue, they pay for future profits. But future profits depend on the revenue of the company, size of the company defines its strength, size of the company defines its ability to earn profits in the future. So sometimes we can refer to sales as our driver. And another good thing is that we discussed our problems with accounting when we calculate PE, but sales are harder to manipulate. So it's easier to work with sales. It's more reliable as a source of information. Another good thing is that sales are always positive. There are no companies with negative sales or zero sales, at least among the companies we should calculate the value for. So this is a better and easier to work with indicator. And although this indicator is not that close to the real value, the real driver of the value of the company, we can use this indicator as another version of multiple. If you don't like sales, because sales, it can be a problem because with price to sales, you don't see the difference between profitable and unprofitable company, between the company that generates cash for you and the company that just burns cash. So we can replace sales with the cash flow. And by the cash flow, we can mean several different things. So price to cash flow sometimes is calculated as current price over cash flow from operations. Sometimes it's free cash flow to equity. And sometimes it's like intermediate cash flow from operations, which is net profit plus depreciation. So net profit without accounts for depreciation. There's no one single definition of what cash flow is for this indicator, so you should carefully check what version you use. But this is another possible approach. So we discussed price to earnings, price to balance value, price to sales, price to cash flow. What else? The last thing that can influence the value is dividends. This is actually unfair to say that dividends are that they work as a driver for value, because there are no companies who pay all their profits as dividends, so you cannot find enough comparables. And dividends are always used not as the main driver in your valuation, but as additional information about a kind of liquidity of your investments. And with dividends, the indicator looks a bit different. We don't use price to dividend indicator, although I listed it here. Theoretically, it exists, price to dividends indicator, but instead we use the inverse ratio, and we calculate dividend multiple as dividend yield, as return in dividends, right? And the same way, by the way, we can calculate every multiple based on price. We can use price to earnings, but we can use earnings yield. We can use book to market instead of price to book value. We can use sales to price and cash flow yield. But for the four first indicators, the most popular version is the left column, and for dividends, we usually use dividend yield, the right column. So that's it about price indicators. But we have another group, enterprise value indicators, and the most important, the most widely used indicator from this group is EV to EBITDA. And you can see that for equity, for price indicators, our main indicator was based on net profit. Here we use EBITDA instead of net profit. Why? Because EBITDA is what the company earned before they paid for their debt, before they paid interest. And the main difference between price indicators and EV indicators is this influence of debt. And that's why EV to EBITDA is often used together with price to earnings, although they it looks like they show the same. They show the relation between the company's value and its ability to earn profits. But in the case of EV to EBITDA, we can use it for any company with different leverage, with different share of debt and its capital. So EV to EBITDA doesn't depend on this leverage, on this share of capital. That's good, and that helps us to work with to find a good set of comparable companies. The same way, it doesn't depend because it doesn't have depreciation. So it doesn't depend on the amount of investments, amount of assets that the company has. And again, sometimes it's very useful, because if you compare two companies, one of which is maybe one of which is using their own buildings, and another rents buildings, then EV to EBITDA would be more stable than price to earnings. And just like with price to sales, EV to EBITDA is sometimes better, just because a mature company usually has a positive EBITDA. We can find a lot of mature companies with negative profits, but EBITDA is usually positive. But of course, excluding those factors, excluding influence of assets, of debt, we lose this information from our conclusion. And by EV to EBITDA, sometimes we exaggerate cash flow available for this company, for its investors, and this is a problem. And one of the ways to cure that is to replace EV to EBITDA by EV to FCFF, free cash flow to the firm. Theoretically, this is a good way to do it, but in practice, this is not a popular way. So still, EV to EBITDA is the main indicator you will use in your analysis. There are other EV multiples. I just mentioned EV to FCFF. With EV to FCFF, you include investments in your calculations. Another possible indicator is EV to EBITDA. The last letter here is rent. So it's earnings before interest, tax, depreciation, amortization, and rent. And excluding rent, we would create a multiple for which the choice that we discussed after the break about Magnit, the choice between showing rent as lease payment or as rent wouldn't change anything, because we excluded that from our analysis. That would make our analysis even more rough, but we wouldn't face distortion from these accounting details. So EV to EBITDA, EV to FCFF. If we have EBITDA, we can replace EBITDA with EBIT, and we can calculate, include depreciation in our calculation, and base our multiple on this indicator, or just like with price to sales, we can calculate EV to sales. On average, I would say that in valuation reports, when people use sales as basis, in at least in three or fourth of cases, I saw EV to sales, not price to sales. So EV to sales is more popular than price to sales. So, and that's our EV indicators, right? We mentioned price indicators, enterprise value indicators. Just to touch the ground, there are other indicators that sometimes put in the set of relative valuation indicators, momentum indicators. Momentum indicators are based either on time series of past values of the price of our shares or of the shares of the company we are analyzing, or on unexpected changes in fundamentals for this company. But although momentum indicators can be referred as relative valuation, they are not from fundamental analysis. They are from technical analysis, so they are not a part of our course. That's it. We discussed it as a theory. Let's go back to our practice. Now, what we had for our companies. One second. So, for Magnit, we collected net profit, debt, then we calculated enterprise value as a sum of net profit and debt, and EBITDA, and the same numbers for two other companies. Now, using net profit and debt, net profit, sorry, in market capitalization, we calculated X5 for X5 and Lenta price to earnings. And you can see that the difference is quite big. So looks like we'll be having problems comparing this price to earnings to Magnit, because with such a big range, we can say that we calculated something expected. All values here look unexpected for us. Okay, we collected also debt, EBITDA, and calculated EV to EBITDA. And you can see that EV to EBITDA is a bit more in a narrow range for X5 and Lenta. And with these numbers, based on EV to EBITDA, does Magnit look overvalued or undervalued? Could somebody answer? Yeah, it's overvalued. Okay, so based on price to earnings, we're not sure, because too much the difference between two examples. With EV to EBITDA, it's overvalued. Okay, let's check sales. These are three most popular indicators: PE, EV EBITDA, EV sales. With EV to sales, you can see that they are surprisingly in agreement. So with EV to sales, it looks like Magnit is fairly valued, right? So now we have one. So here is fairly. So now we have one decision that it's overvalued, one decision that it's fairly valued, and one decision undecided, because we decided not to use these numbers. But if we believe that we should use something here, then probably our conclusion would be that Magnit is undervalued as compared to X5, because X5 is just bigger than Lenta. It's closer to Magnit. Maybe 22 would be closer to what we use as our price multiple. So we have now sales. Sales is revenue, our revenue. Just sale revenue from the income statement. So we have three decisions: undervalued, fairly valued, overvalued. And unfortunately, we don't have any universal rule to choose from these three decisions. We just have to, if we have to decide, is Magnit overvalued or undervalued, we should analyze the structure of this business, analyze sources of information we use, and decide which one multiple is the best estimator for the value of this company. And by the way, for things like that, and for any indicator that doesn't look like this one, sorry, not this one. Yeah, this one. Here it's the question about average EV to sales multiple is very simple, because average EV to sales is equal to both EV sales. We calculated, we have the same numbers for those two indicators. But for this, we should calculate somehow the average number. What we should apply to Magnit EBITDA. So the question for us is how we calculate average numbers. There are several possible approaches. First, the approach that can look very simple, we can just calculate arithmetic mean. So for EV to EBITDA here, we just take 3.65 plus 4.28 over 2, right? It's simple, but not very popular, because with arithmetic mean, if we have an outlier, a multiple with very high value because of some distortion in financial reports, it will distort a lot all our calculations. So it's not very popular. What can we use? First, quite a standard way to do it: median. Median doesn't depend on outliers. So if we have like 6 results with values between 4 and 6, and then the 7th one is 25, this 25 doesn't distort our median value, and we still will use something closer to the main group. And another possible approach, although I would say again more theoretical, but you can use it, and you should definitely know that for the exam, for CFA exam, is harmonic mean. Harmonic mean is basically 1 over the sum of 1 over the mean of the sum of 1 over the indicator. I will show you for this our price to earnings indicator. If we calculate average price to earnings with harmonic mean, we use 2 over the sum of 1 over 22 plus 1 over 6. 0.8, and we get about 10.5 as our average price to earnings. We can calculate harmonic mean taking equal weights for each benchmark, for each comparable company, or instead of that, we can use weights for each company, and this is weighted harmonic mean. But again, this is I would say rare. So median would be your first choice for averaging of your multiples, and harmonic mean can be another way to do it. You can calculate average arithmetic mean as well. This is not that bad, just not so popular. Median is more popular approach. Okay, so this is how we do it. This is all the theory, and just let's quickly run through this process again. So the first step is to choose your indicator. It can be price indicator or EV indicator or momentum indicator, but basically it's price and EV. Second, find your benchmarks, either industry peers. 3 to 6 would work. 3, I wasn't right here. No, I would say 5 to 10, not 3 to 6. With 3 companies, you'll have poor quality of calculations. Third step: collect all data for these benchmarks and your company, and create a table for your future calculations. Second, next, choose the method for averaging so that you calculate or put it in a formula to calculate average indicators. Then calculate your target multiple, apply it to your company, and you get the result. And with this result, you'll come to a conclusion: is this company overvalued, undervalued, or fairly valued? So this is the process. Basically, it's quite simple, but of course you'll face a lot of issues related to quality of data, related to how comparable your benchmarks are, and so on. And within this approach, we listed a lot of possible indicators, methods, and so on, but they are not equal. The most popular is PE as the basis for calculation. Beta here, just skip it. That's because the question in this survey was about other approaches as well. So PE, then EV to EBITDA, then size. Size is actually revenue. Then price to balance value, and price to free cash flow. So seeing that, you can guess that even if you know other indicators, your choice in most cases, unless you have a very serious reason to do that, your choice will be within this short list of indicators, and you will not use all the others. You just should know them just for general education. Okay, so this is the approach the relative valuation approach. And now the last thing. Today, Magnit declared that it acquires Dixie. Dixie is another retail chain. It has 2,600 stores in several regions. And for this deal, Magnit disclosed that the annual revenue of Dixie is 281 billion rubles in convenience stores and something like and 17 billion in superstores. So the structure of this business looks like about the same as Magnit's. Some supermarkets, but basically mainly it's convenience stores. And for this deal, the price for this deal would be 92 billion rubles. So the question that posted on the LMS now, the question for this lecture, what do you think? Based on price to sales multiple, is Dixie business valued higher than Magnit business? I mean, in terms of price to sales, or lower, or maybe about the same. And that's it for today. As before, you have 1 week until 6:30 the next week, the next Tuesday, to answer this question on LMS. I'm waiting for your draft reports, your draft models, your questions about Volkswagen case, and see you next Tuesday.